Out here, it's easy to pretend that there is no environmental crisis. But even here, if we look round, we can see a polluting factory, polluted estuary, a quarry, the polluted North Sea. The list goes on. Of course, an accountant might say, but it's not my problem. It is our problem. We as accountants are part of that problem and therefore have to take some responsibility to helping solve it.
Rob Gray is Matthew Professor of Accounting and Information Systems at the University of Dundee and Director of the Centre for Social and Environmental Accounting Research. In this film, he explores the links between accounting and the environment.
We all of us maintain contradictions in our lives. In our private life, we seek to be responsible, but we still take decisions which have impacts on others. The decision to drive a car produces air pollution, produces noise pollution, even though we don't intend it to. Same's true of our work lives. We seek to fulfill our jobs as best we can. We're responsible in our working environment. However, all the activities we undertake have environmental consequences that we don't explore. This is particularly true of accountants. We don't look behind the information that we present, and we don't realise the way in which we're encouraging private organisations to take decisions which lead to environmental consequences which are then borne by the public. The essence of the problem is this. If we think about the West in particular, we've been very successful at increasing our state of well-being, our material well-being. But think of the planet as a whole and think that the planet consists of two types of things. One we can call natural capital, the trees, the birds, the resources, the water, the air. On the other, we can talk about man-made capital, our clothes, our washing machines, our cars, our roads, our buildings. We've got these two things. And what we do know is that the man-made capital has grown and grown and grown. In the West, we've been very, very successful. But that growth in man-made capital can only come from one place. It comes from the natural environment. And as our man-made capital rises, our natural capital must, by definition, fall. There must come some point where that natural capital is no longer large enough to support our way of life. Some would argue we've already reached that point. Why does that affect accountants? Well, that's easy enough. How do we know this man-made capital has been rising? We know because this is the stuff we measure. This is the stuff we've got prices attached to. And through our profit figures, through our gross national product figures, we can see it rising. Our enormous success is rising. What we don't measure is what it's costing in terms of the environment. The accountant only accounts for things that have prices attached. The environment doesn't. If we transfer building land, we transfer its economic value, not its habitat value. The environment does not have a price attached. Therefore, the accountant ignores it. What we need to remember is that accounting is a very powerful image maker. It has an enormous influence on the way that management, employees, customers, shareholders especially, and politicians think of organisations and how they think of successful organisations. A successful organisation is one with a good earnings per share, a good profit figure, a good return on investment. Those are accounting measures. And those accounting measures do not include any decline in natural capital. So we can be ruining our natural capital and yet reporting success. Every side of success has another side. We need to turn it over and have a look at the underbelly of the thing. And the underbelly is the decline in our natural capital. We can't afford to let it carry on declining at the rate it is doing. Accounting can't measure the full extent of that decline, but what we can do is recognize the limitations in what we do and why therefore we take a responsibility for encouraging environmental degradation. That, broadly, is what environmental accounting is going to seek to address. When we talk about natural capital, it's very difficult to find any areas of the planet which have been untouched by man. But when you look around something like this, it's beyond accounting, it's beyond numbers. And whilst we can work out the cost, maybe, of putting a place like this together, it seems so improper to try and value it, to try and put any number value on a place like this. It's beyond value, it's beyond price, it's beyond words. It's just a very, very beautiful place. What sorts of things should accountants be doing? Environmental accounting, in the end, is only limited by our imagination. Environmental accounting is many things. Because we're still learning as we go, we can probably identify 6 different levels to environmental accounting. The first isn't really environmental accounting at all. It's accountants ignoring what's going on and letting the prices, as they change, the price of waste, the price of energy, reflect in their figures in the normal way. Nothing changes. What, after all, do accountants know about the environment? As laypersons, they may well know about birds and trees and the like, but as accountants in their training, the environment just doesn't feature. I think this would be a mistake to use this as an excuse. After all, accountants do know about information. They know about information systems. They know about pulling information together and performance appraisal. They know about evaluating information. This is what we're talking about in terms of environmental accounting. After all, accountants happily sign an engineering company's accounts, and there's nothing in their training about engineering. They'll happily sign a set of accounts to do with a shipping company, and shipping law doesn't tend to feature very highly in accounting training, and so on and so forth. Because this is what we're talking about. It's the production of information that's usable within the organisation, within the management systems, within the performance appraisal systems, and within the external reporting, but based on the expertise of others. Now, of course, accountants can't measure biological oxygen demand as accountants. They can't measure biodiversity. They can't measure levels of land toxicity. Of course not. But what they can do is rely on those systems as provided by others. Because one of the things that's significant about organisations is that their major information flows are those which determine how they see the organisation and how the organisation is run. And there's no question that accounting and accounting systems are perhaps the most developed. Unless we can get environment into that system, the accounting system, whenever there's conflict, is going to dominate the environmental system. The second stage is to go a little beyond that. Areas like waste and energy permit an accountant to think of new ways of itemising items in their accounting systems, recharging it to profit centres or to cost centres, and to helping the organisation recognise those areas where price and the environment do interact. Rome Polenk's experience in this is particularly useful. They found that bringing those costs out of overheads and back to line managers encouraged the line managers to investigate ways of reducing energy, ways of reducing waste. And the effect was good both for the environment and, of course, for the company. The third stage is something we're starting to see beginnings of in the UK, but has been quite extensive in the US. And that is recognising that we have to find new ways of capturing the interaction between the economic and the environment. Most obvious of these would be provisions for new technology, provisions for clean-up. It's having impacts on things like contingent liabilities, our land valuation processes, new business risks. This is also the area where the auditor is starting to get exercised. Certainly many British auditors are worrying about how they can define a true and fair view in a set of accounts which don't take any cognizance of the environment. This stage is where the accountant actually has to start being a bit proactive. There's no question that in many areas of business activity there is a conflict between economic criteria and environmental criteria. The classic area would be investment appraisal. In investment appraisal, we are looking to choose to invest in a new company, a new technology, a new process on relatively short-term financial criteria. It's possible to recognise that this will often conflict with environmental criteria and look for new ways to unpick that. One could perhaps give 4 groups of examples. The first is companies as diverse as Alcan and the Co-op Bank, using their mission statements, their environmental statements, as the driver for all new investment. The second area is companies starting to introduce hurdle rates. That is, they will not invest unless it actually meets some basic environmental criteria. This must become more common. The third area, maybe ICI is the best example here. They've invested large amounts of money just to bring themselves up to the highest environmental standards. The publicity surrounding a company of ICI's stature just gives some idea of how important investment appraisal is when the environment is reconsidered as a major business issue. The fourth area is the one that hasn't really got going yet, but I can see accountants having an important role, and that is actually trying to unpick current investment appraisal standards. Whether we use payback, net present value, internal rate of return, all of them have a tendency to encourage the economic over the environment. All of them have a tendency to encourage the short term over the long term. And if we are going to aim towards sustainability, some of this has got to be downplayed. This does not necessarily mean making a bad business case, but a business case that takes the environment and the longer term into account.